Hello, this is another video from Anonymous. Today I'm going to be taking you through a consolidations question in F7 financial reporting. This is the June 15 paper, question 1 in section B. Now, general approach with these questions would be to break down the text, figure out what's written, and then go on to put down a few key points and then answer the question. So I'll take you through the general gist of the question first. So this is a company called Bycomb who has acquired 80% of Cyclops equity shares. Now, as you can see, there's been a share exchange and also a deferred consideration payment. As you go through, you're given the SPL for Bycomb and Cyclops. You are also given extracts from the statement of financial position, being the equity section, and then a series of notes. So, first approach would be to take down the key points. As mentioned earlier, mid-year acquisition, 9 months till the year end. 80% was acquired. Share exchange and deferred cash. And then it'd go on to read the notes. So, for example, for section 1, it says that the date of acquisition, the fair values of Cyclops assets were equal to their carrying amounts, with the exception of an item of plant, which had a fair value of $720,000 above its carrying amount. The remaining of the plant at the date of acquisition was 18 months. Depreciation is charged to cost of sales. So here we can see that this is a fair value of net assets adjustment, and it also affects depreciation. And then we go on to number 2. So to summarise this in general, what's happened is under local accounting policy they have actually expensed the $100,000 of interest for borrowing costs. However, under IAS 23 this qualifies to be capitalised. So this would mean if we have any adjustments further down, we would not expense this, so this would have to be removed from our P&L and capitalised. Section 3 tells us that there's been intercompany trades between Bycomb and Cyclops. This looks like it's Bycomb to Cyclops, so it's parent to subsidiary. This means we've got a PUP adjustment, so provision for unrealised profits. Note 4 tells us that Bycomb's policy is to value the NCI at the fair value at the date of acquisition, and for this purpose we should use the share price of the NCI at the date of acquisition. Note 5 tells us there's been an impairment to Goodwill by the year end, and the impairment will be charged to cost of sales. So, Section A asks us to calculate the Goodwill at the date of acquisition of Cyclops. Now, Goodwill is put out in a general pro forma. What we have is at the top we have our consideration. We then have a fair value of NCI. We then deduct the fair value of the net assets at acquisition from here to give us consolidated Goodwill at acquisition. If the question had asked us for Goodwill at year end, we would then go on to deduct impairment from the Goodwill at acquisition, if there was any, which in this case there is, and then that would give us Goodwill at year end. However, we're asked at acquisition, so we're going to continue. So, starting from the top, under consideration, we now know, as mentioned in the notes earlier, there are 2 parts to the purchase of Cyclops: a share exchange and deferred consideration. So with the share exchange, we know that we have 2 shares in Bycomb for every 3 acquired in Cyclops. So what we do here is we look at the equity shares, which we know there are 12,000. We multiply this by 80%, 0.8, to give us the amount of shares acquired. And then we multiply this by 2/3 to give us the amount of shares exchanged in return. This is all then multiplied by $3, which is the market value of Bycomb at acquisition. This gives us a consideration value of $90,200,000. We're then told there's been a cash payment due on the 30th of June, which is 1 year from acquisition, of $1.54 per share acquired. This is per share acquired, not share exchanged. Bycomb's cost of capital is 10% per annum. This tells us that we have to calculate the cash paid in 1 year's time and bring this to present value. We do this by using a very simple formula, which is the value of the cash multiplied by 1 over 1 plus the interest rate, 1 plus the interest rate being to the power of the number of years till payment. In this case, 1 year, so to the power of 1. So what we've done here is we've calculated the amount of shares acquired, again 12,000 multiplied by 80%. We then multiply this by the value paid per share, which is $1.54, and then use the discounting fraction to bring us down to a present value. Now, another thing to bear in mind with this, which should hopefully come later, is the fact that this is to the present value at point of acquisition. So within your accounts there will also be a finance cost charged for the year, which is the unwinding of the deferred consideration, and this unwinding will occur at 10%. So now we've calculated our consideration, we then look at the fair value of the NCI. Now this is probably one of the nicer parts of this calculation, and all we have to do here is multiply our NCI percentage by the number of shares in the subsidiary and multiply that by the market value of the subsidiary's shares. The subsidiaries, not Bycomb's. So as you can see here, we have 12,000 shares multiplied by 20%, which is the remainder from the 80% acquisition, and we've multiplied this by the $2.50 for the market value of the shares of Cyclip at acquisition. Once we've done this, we then total these up to give us our overall consideration, and then we go on to the next part of the calculation. So here we deduct the net assets, fair value of the net assets at acquisition. To do this, we set up a nice little pro forma, which you can see underneath as working one. In this calculation, we're not asked for the post-acquisition year ends. However, I've put this in to illustrate. So our net assets of subsidiary consists of the following: 2 columns, one at acquisition and one post-acquisition year end. Here we are given share capital, share premium, retained earnings, fair value adjustment, fair value depreciation, and any possible policy changes, and any provision for unrealised profits from subsidiary to parent. Here in this question we don't actually have any policy changes or provision for unrealised profits with relation to subsidiary to parent. However, I put it in so you can understand that this is a pro forma, a general pro forma that can be used in examinations and continued. So the share capital, we're aware from the question that the share capital is 12,000. Now this share capital figure in the F7 examination will not change at acquisition and post-acquisition year end, so they will always be the same figures. Share premium, there isn't any in this question. However, if there was, this would be the same as a share capital. It would not change between acquisition and post year end. Retained earnings. Now retained earnings is probably the worst part of this question in many terms, because it's a calculator field. So in this question they've given us a couple of bits of information and we have to work out the retained earnings at acquisition. Now, they've given us the retained earnings at the beginning of Cyclip's financial year, which is here, 13,500. So we know this is our starting point, 13,500. We are now also aware that there's 2,400 or 2,400,000 of profit after tax for the year. And as we know, our retained earnings will be our retained earnings at the opening of the year plus profits after tax. However, there's also £100,000, sorry. This 100 is to do with the removal of the expensed borrowing costs from our P&L. We have added this back to our profit because we are now going to capitalise this. If we were performing a full statement of financial position, you would see this there. We have then gone on to multiply this by 3 months out of 12. This being the 3 months till the date of acquisition of over 12 months of the year. Under this assumption, we should assume that profits accrue evenly throughout the year unless mentioned otherwise. So we've used a straight apportionment. This gives us 14,125, and then our post-acquisition year end retained earnings. So the retained earnings at the year end will be your 13,500 plus the 2,500. Fair value adjustments. Now the fair value adjustment here is 720, and it's 720 post-acquisition year end. Note the depreciation will only occur at the year end point. This is because depreciation can only occur on the asset once it is used. We don't depreciate the asset from the beginning, we depreciate over the life of the asset. There's been no policy changes as mentioned and no PERT. So this gives us, at acquisition, 26,845. So these are the net assets of our subsidiary. We then go on to deduct this from our overall value of consideration and fair value of NCI to give us consolidated goodwill at acquisition of 11,795. So 11,795,000. So this is your goodwill question, and to be quite honest, goodwill questions are nice. They're part of the statement of financial position, and these would go in under your non-current assets when you're writing out your statement of financial position. Once with good practice, you should be able to get a good few marks on here. And remember, you get pickup marks for writing in your numbers and writing in your method. Now note, just before we move on to 1B, note I did calculate the post-acquisition year end even though not required. Now the difference between these two values gives you your post-acquisition profits. Now when you're working out your statement of financial position calculations and consolidation, there are two other workings which are workings 4 and 5. One to do with your NCI and one to do with your retained earnings. These workings require this figure of 1515, so I've put this down to demonstrate and illustrate what you might have to do in consolidations with full statements of financial position. Okay, so let's move on to 1B. Now with 1B, it's asked us for 4 different calculations. Starting from the top, the revenue. Now the revenue on consolidation should be quite straightforward. What we do here is we take the full revenue for Bycomb, the parent, and 9 out of 12 months of the revenue for Cyclip. This being 9 months from the date of acquisition to the reporting year end. What else you'll notice in that revenue calculation is a deducted 3 million. This 3 million is to do with note 3. In note 3, it has told us there's been $3 million worth of trades with 420,000 left in inventory. Intercompany trading as an adjustment is deducted both from revenue and cost of sales. Not what is left in inventory, but the entire traded balance for the year. So in this case, there's been £3 million worth of trades, so we have deducted 3 million from the revenue, and in the next calculation, as you'll see, we'll go on to deduct that from cost of sales also. So overall, once we've calculated all these figures, it brings us down to a revenue position of 29,300,000. Moving on, we then move to cost of sales. Similarly, with revenue, we take the full cost of sales for Bycomb and 9 out of 12 months of the cost of sales for Cyclip. So this then gives us 17,800,000 and 5,100,000. And as mentioned in the revenue question, we then deduct our 3 million from cost of sales. So this is 3 million of purchases and this is 3 million of sales. These both reduce our revenue and cost of sales, ensuring we don't account for profits with an intercompany trade. Once we have reduced these values, we then have our PERP. Now, with regards to PERP, provision for unrealised profit, we have to add back the profit on the inventory remaining of our intercompany trades. So what we have here is 420,000, and this works on a markup basis. So markup being on cost, so where cost is 100%, cost plus profit would be 120%. So for us to get 20% of our overall value for profit, we do 20 over 120 multiplied by the 420,000. This gives us a value of 70, which we add to our cost of sales. Remember, adding to your cost of sales means it increases, which reduces the profit. We then have an impairment of 500. This is from note 5 and directly taken. And as you can see in note 5 itself, it does say impaired goodwill is charged to cost of sales. And then as our final addition to cost of sales, we have depreciation from our fair value adjustment of 720,000. So we have depreciation of 360. This is taken from 720,000 of the fair value adjustment, so the increase in the carrying amount by 720. We then divided this by 18 months to give us a value of depreciation per month, and multiplied this by 9 for the months of the year end reporting period since acquisition. Overall, this then gives us a cost of sales figure of 2830. And then B part 3 asks us to talk about, actually give the finance costs. So here, in a similar manner as to above, we take the full finance costs of Bycomb. And then if you remember earlier, we had the finance cost of 100k, which was expensed to our P&L. Now, if you remember further up, we'd looked at our overall profit figure and we'd added back the 100k to our profit. So that means we've deducted it from our finance costs for Cyclip. So what we do here is we take 300k from Cyclip's finance costs, we deduct the 100k which we have now capitalised, and time apportion this for 9 out of 12 months since acquisition to give us 150. If you remember us earlier, we talked about deferred consideration and unwinding. With regards to this, so we now have this total value of 13,440, and we have to unwind a full year's worth of interest till payment at 10% to bring us to the value of payment at that point in time. However, we only have 9 out of 12 months of that year to unwind. So what we do is we take our deferred consideration payment of 13,440, our cost of capital of 10%, which is what we also used to discount to present value. We multiply this by the 10% and time apportion a full year's worth to 9 out of 12 months. This gives us 1,008. So overall, we now have finance costs of 1,558,000. As the final part to section question B, it's asked us to calculate the profit or loss attributable to the non-controlling interest. Now, with a P&L attributable to the NCI, there is a general pro forma for this. So what we can call it is, an easy way to remember, is your profit after tax less DIP. D for depreciation, I for impairment, and P for perp, where it's subsidiary to parent. In this case, remember, we didn't have any, however it's placed here to show you the overall pro forma. So we figure out our profit after tax for the subsidiary for the reporting period. So as you can see, we've got our 2,400,000 from profit for the year. The addition of the 100k of now capitalised finance costs. And this is time apportioned to 9 out of 12 months for the year to give us 1,875. So 1,875,000. We now know any additional depreciation from our fair value of net assets calculation earlier was 360. We deduct this, and as we said earlier from note 5, we have an impairment of 500k, which we also deduct. This gives us a profit or loss for the subsidiary of 1,015,000. So the profit attributable to the NCI will be 20% of the overall profit of the subsidiary. 20% of that 1015 gives us 203. Thank you for listening. And please stay tuned for more videos.